Welcome to Cambridge House Live. I'm Bridget Anderson and I am joined by David Morgan, the creator of silverinvestor.com and the author of the Morgan Report. Thanks for joining us.
My pleasure.
You just wrapped up a presentation about the silver market and the myths about silver. Let's start there.
Okay, well, one of my favorites, it's kind of a rant. I went off on one that really infuriates me, and that silver is not money. Because the words silver and money are synonymous in many languages. So it's like saying money isn't money or silver isn't money. It wouldn't be understood in the Hispanic languages or Latin-based languages. Secondly, silver's been used as money more places, more often for longer periods of time than gold has. Gold certainly is money historically, but it's usually nation-state to nation-state transactions. But the merchant class, or the people, use silver in their transactions on an honest money system, and it's always been that way. That's not to say that silver doesn't have an industrial component. I fully acknowledge that. But regardless, silver really is a monetary metal.
So what is the outlook for silver?
It's very bullish, but it's very volatile. It's always been that way. Silver is a small market relative to gold. It doesn't have as many fans as gold. It's sort of the underdog metal. It's misunderstood. So because there's so many dynamics in the silver market, the price can be pushed around quite easily up and down. And I expect to see more of that as the financial system continues on the path that we're on. But due to the fact that it is a wealth preserver, it has every attribute that gold has. It's divisible, it's recognizable, it's fungible. Everything that's hit on a classic monetary standard is equal to silver and gold. I see as things unwind further, there'll be more and more people waking up and seeking something that has those classic values. So silver, I think, is going to have more demand going forward.
You've been following silver for a long time. You're a real fan. What's the interest there?
Well, a couple things. One, when the bull market took place from the early mid-60s through January 21st, 1980, we just celebrated the 32nd year of the high in gold yesterday. And that was January 21st, 1980, where we hit 850 on the spot market and 875 in the near month. That is the all-time high in real dollars, even though today we're at $1,600 gold. In real terms, we'd have to be about $2,500 to be in real, true new highs. So when that took place, silver that year went from roughly $6 to $50 in 1 year. And that's something that I haven't covered recently, but that 90% of the move usually takes place in the last 10% of the time. So the people that come to me and say, well, David, I really love your story, I love the silver story, and I think you're making a lot of sense, but I've missed the move. Don't know how markets move, because the greatest upside to silver comes in the last portion of the move. And it's not only silver. That's true of the tech wreck, that was true of the housing bubble, it's true of most markets. It's especially true of silver for two reasons. There's no competition for anything on the planet like there is for saving or preserving wealth. And the fear factor is much more motivating than the greed factor. This time I believe it'll be a worrisome overlay or overtone, because people will say, you know what, this thing isn't working. My retirement isn't going to help me. It's going down, not up. My housing prices are going down. My real estate portfolio looks bad. Stocks aren't doing it for me. And they start to turn to the asset of last choice, which is gold and silver.
Okay, so any correlation to your outlook on gold then?
Yeah, I'm very bullish on gold. I think everyone should own both, especially the older you are. Silver is volatile, so if you're 60, 70, 80 years old, you should have mostly gold weighting in your portfolio, not silver. If you're younger and more aggressive and you can take the risk, like I can, I've got ice water in my veins, certainly then, because I've been in silver so long, then you could certainly ride the silver bull. But it is a tough ride. It's like riding a bucking bronco in a rodeo versus getting on the biggest, baddest Brahma bull you've ever been on. You want to ride that bull, you want to ride that silver market, go ahead, but it's not an easy ride.
Okay, and what about gold? How high do you think it's going to go?
Oh, I think minimum we got 2,500. That would just be par with the 1980 high. 1980 wouldn't have near the problems that we have now. It was basically a problem within the United States, an inflationary-based problem. We had 13% inflation officially. Volcker came in, pushed interest rates well above 17% on the short term, and it caused the markets to collapse in gold and silver. Now it's a global problem. It's pervasive throughout the entire system. We all are interconnected, and we have 6 times the money supply in just M1. I think this problem is so bad this time, and not that it's the end of the world, not that production stops, not that there's going to be massive failure, but there are going to be failings within the system, and it's mostly financial. Remember, if everything collapses, all the wealth stays in place. No roads blow up, no oil wells go away, all the corn doesn't evaporate, all the real wealth stays in place. You know, paper money is not wealth. That's the system that implodes. So what happens is there's a restructuring of the system to redistribute the wealth, hopefully more honestly, throughout the financial structure that reemerges.
Do you see that imminently then?
I see that happening within 2 to 3 years. I really don't think it could go more than 3 more years, but I'm willing to admit I'm wrong, and we'll have to wait and see.
Okay, so when you look at what's going on with gold and silver, taking a look around the room at some of the junior miners then, what's the trickle-down effect and where are the opportunities? Where should investors be looking?
Well, I'm very opinionated in this space, as you know. I think the real opportunities are in your mid-tier growth companies that are producing already, because they have a way to increase their production, they have a way to get their capital costs down by being better performers, they have assets that they can go and mine certain areas that are richer grade or less rich grade, so they have a lot of variables in that space to increase their bottom line without the price of gold and silver increasing.
So, just to interrupt you, when you look at the price of gold and silver stocks, so they don't move in lockstep with gold and silver all the time, rarely in recent years. So why is that? And do you see that changing?
I do, and you're right. They primarily haven't because almost all equity investors, these Section 7 licenses in the United States, I don't know what the equivalent is in Canada, are restricted from buying the commodity. That changed. It changed when the ETFs were started. So now an equity investor that manages money that can only buy a stock can buy a stock but actually is buying a commodity. That's true with the SLV or all the other silver ETFs and the gold ETFs. Well, a guy that's managing money that wants exposure to silver doesn't necessarily want the risk in a silver mine, even the best silver mine in the world, or the best silver mining company that's globally based. So it's much easier for them to go into an ETF and get the exposure they want with not nearly the risk that they had in the past. The only way for an equity investor to get silver or gold exposure in the past was through the mining equities. They don't have that problem anymore. That's number one. And the follow-on is, well, does it represent opportunity now or not? And the answer is yes. They're very, very undervalued. In fact, Wall Street, in my humble opinion, really doesn't see the future very well. If you look at this gold price on an average basis and the silver price on an average basis, and you take that to the bottom line and look what a quarterly income statement would look like and the balance sheet structure, you can see in a lot of these cases you're going to have great, massive profits coming down the road. And if you anticipate that, you should be buying now, because those profits are pretty much locked in now. But that's not the way Wall Street works. Once they see record earnings quarter after quarter after quarter, and 3 quarters go by, then they'll put it on their buy list. Well, my people have already been in those stocks for 2 years.
Any jurisdiction that you look on more favorably than others?
Oh yeah, that's a problem. I was big in the South Africans in the first bull market. I'm old enough to have been there. And I do not like South African generally. I look at everything on an individual by individual, case by case basis. I don't want any of my members coming back and saying, well, David, you said this on TV. But generally speaking, no, I'm risk adverse. I do not like the Russian atmosphere. I like their assets, but not the structures of deals that were done and didn't work out well. Ducat being one for Pan American. There's another one with Silver Standard. They both got burned. South Africa, I'm very tentative on. And then, of course, even some of the South American countries, Venezuela, obviously, and then you've got this problem with Argentina that surfaced recently. And you can't blame them. I mean, there's a book out there called Resource Wars, and if you read it, you're going to see that people in these nation states are going to covet assets that are real, that are true wealth. And you can't blame them. It's in their property, it's in their backyard. What do you expect them to do? As things unwind further, you're going to like sell your best asset for some piece of paper from somebody, you know, who has a smile on their face?
What's your advice to investors when they're looking at the junior mining sector?
The junior mining sector spread out, but not too much. I don't like long lists. I'm a fan of William Murphy that started Investors Business Daily. He has a statement that he says, if you can't pick 6 stocks and get it right, you don't know what you're doing. I pretty much agree with that. It's really hard to do that in the juniors. I pick about 10. But you got to do your homework, you got to do your best effort, and it's really hard to find juniors that are explorers, because no one's got that magic, X-ray machine that you can look down and see if the asset is there or not. But there are juniors that have different models of things that are not necessarily just the resource base. For an example, one that I've liked and held for a long time is a drilling company. A drilling company is like in the 1880s or so when you were having a gold rush, you're selling picks and shovels. Those guys were guaranteed riches. While these other fools are out there breaking their back for 12 hours a day looking for gold. Some found it, some didn't. But the guys selling the picks, the pans, and the shovels did quite well. That's a drilling company. So that's one of our juniors as an example. So I'm well known to be a thinker outside the box, and that's one example of what we look for. That's a junior company that might have great upside with not much risk. I'm pretty risk adverse, even though I'm a silver bull and I've ridden it for a long time. In the portfolio, the best I can do it, I try to keep the risk low.
And research. Thanks very much for joining us, David. I appreciate your time.
My pleasure. Thank you.